Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now.
Fiverr is one of those stocks that was an absolute favorite early in the pandemic, but shares have actually dropped to the point where they're about flat from their pre-pandemic level, and investors don't seem to be giving a lot of credit to the way that this company has grown over the last 3 years. So I want to dig into the numbers, what investors are thinking about Fiverr, and then what to look for when quarterly results for the first quarter of 2023 are released next week. My name is Travis William. Thanks for watching Rive Investing. Please subscribe here on YouTube for all my content, and let's dig right into the numbers. These are the key results from the fourth quarter of 2022. So this is a quarter ago, but you can see that revenue growth has really slowed to 4.2% last quarter. Gross margin, though, is still phenomenal. This is one of the things that I keep going back to with Fiverr, is that they've got an incredibly good gross margin for their business. Buyers also continue to be very active, 4.3 million active buyers, and they're spending a pretty significant amount of money, $262 on the platform. Adjusted EBITDA was 9.4 million. Now, if we look at guidance, that is the guidance for this quarter on the left here, 86.5 to 88.5 million dollars. So a little bit of growth expected for the first quarter of 2023, and adjusted EBITDA about flat. Annualize those numbers, and that's about what you get for full year guidance. So not expecting a lot of growth. I do think it's interesting though that adjusted EBITDA is expected to rise a little bit, because the average here is going to be about $12 million in EBITDA at the midpoint. So management seems to be fairly bullish on the future. I also wanted to highlight this chart here that they showed in the last earnings release. And this is just a color coded look at revenue per cohort. So a cohort is when a customer comes in and starts using a platform. You can see that customers who started in 2010 or 2011, not spending a lot of money, but people who came in 2015, 2016, 2018 are still around, are still generating significant amounts of revenue for Fiverr. And then there's this new cohort of people, and that's really where you're seeing a lot of the growth. So the challenge here is that Fiverr needs to keep those cohorts growing, to keep the business growing, but it's been able to do that over time. I also want to show these couple of charts here to just show how much the business has changed and how much investors are really not pricing into the valuation for Fiverr right now. The stock is actually up 54% since the start of 2020, but over that same period of time, revenue is up 215%. So the price to sales multiple has come down significantly. You can also see here that Fiverr is generating a positive free cash flow, despite the fact that it's generating a negative net income. Now, the reason for that, most of the discrepancy is because of stock-based compensation. This has become a hot topic among Silicon Valley companies in particular, because they've given out a lot of stock as part of compensation plans for employees that dilutes shareholders, but it doesn't actually take away from your cash. So that's the reason that a lot of companies like to use that. Something to consider when you're thinking about buying a stock like Fiverr is that the company is using stock as a form of compensation for employees. Now, Fiverr has about a $1.4 billion market cap, and there are significant improvements that I would like to see in the company, from its operating cost structure to the amount of stock-based compensation that it gives out to employees. But at the end of the day, I think Fiverr is part of a structural change that we're going through in employment and the way that businesses work. You can now start a business from anywhere in the world and do small contract jobs with other freelancers or contractors through a platform like Fiverr and use them like quasi employees without actually having to hire them and pay benefits and things like that. So that's a structural change that has happened and really exploded over the last 3 or 4 years. Fiverr is really at the core of that. So I think that's ultimately a valuable place to be. It's a two-sided marketplace, and this is obviously one of the leaders in the market. But it's not without risk. So that's worth acknowledging for a company like Fiverr, is that it's not generating a profit right now on a net income basis, despite the fact that it is generating positive free cash flow, as I mentioned. So when earnings are released next week, the couple things that I'm going to watch is, what does revenue growth look like? What does that user base look like and user activity? And then what are operating expenses looking like, and which direction are they trending? Because if the company is able to really cut back on expenses, but keep revenue slowly but surely growing, there should be a lot of operating leverage in this business, and that should pay off for investors long term. Not a very expensive stock if the company can execute on its growth plans. So keep an eye out middle of next week for earnings. Check back here for more Don't forget to subscribe to Rive Investing. Thanks for watching, everybody. I'll see you here next time.